Welcome to the Deep Dive. Today we're digging into e.l.f. Beauty, specifically their latest earnings call for the fourth quarter and the full fiscal year 2025.
That's right. We've looked through the details, and it really shows a company firing on, well, most cylinders, but also facing some pretty big questions and making some bold moves.
Okay, let's unpack that. Fiscal year 2025, the big picture numbers look frankly pretty impressive. Net sales jumped 28%.
Yep, and adjusted EBITDA, that key profit measure, grew right alongside it, up 26%. Very strong.
And crucially, these weren't just, riding a wave. They actively grabbed market share. Big time.
Huge gains. We're talking 190 basis points in the U.S. That's 1.9%, 170 in Canada, and a massive 270 basis points in the U.K. That's 2.7% share gain there.
Gaining that much, that fast.
It's quite something.
And here's the bit that really stands out. Cure 4 marked their 25th consecutive quarter 25 of both net sales growth and market share gains.
Yeah.
I mean, 6 years straight of growing sale and taking share. How many public consumer companies can say that? It's incredibly rare.
It really is. It suggests, the fundamentals are just working, great products, the value's right, they're executing in stores. It's not luck.
It's momentum.
Built-in momentum, exactly. And for Q4 specifically, profitability really popped. Adjusted EBITDA was up 99% year over year.
Wow, doubled almost.
Pretty much. And adjusted earnings per share, $0.78 compared to $0.53 the year before. So a big jump there too.
Okay, so strong numbers, but beyond the performance, the call really seemed to focus on two big things coming up, right? Tariffs.
Tariffs, yes, and the potential impact there. And this huge news, they're acquiring Rhode, the Hailey Bieber brand.
Rhode, right, a major acquisition.
Exactly. So it's not just looking back, it's very much about what's next. How do they handle these tariffs? How do they integrate this big new brand? That's the story now.
Let's dig into Q4 performance a bit more first.
Yeah.
Because the full year was great, but Q4 sales growth, just looking at the number, was 4% year over year.
Right, 4%, which, might sound a bit low compared to the full year. But you absolutely have to remember that 4% is stacked on top of 71% growth in Q4 the previous year.
Okay. That context is crucial. So 4% on top of 71%, that's still adding a lot of actual dollars.
A significant amount. And that growth, it was across the board, digital channels and retail stores.
Graphically.
U.S. sales grew 1% in Q4. That's probably where those really tough comparisons hit hardest. But international sales were much stronger, up 19%.
Okay, and what drove the overall 4% growth in Q4? Was it price or volume?
Mostly volume. They sold more stuff. Higher unit volume added about 8 percentage points to growth.
So volume up 8 points, but total growth was 4 points. What offset it?
Right. There was a 4-point headwind from price and product mix in the quarter. Could be some promotions, maybe a shift to slightly lower priced items within the mix. They didn't really dive deep into that specific mix shift on the call.
Got it. But look at the gross margin, 71% in Q4. That's really healthy and up slightly, 50 basis points.
Yeah, very strong margin. What helped there? Mostly favorable FX rates on goods coming from China and also lower transportation costs than the year before. So some good operational efficiency and maybe some helpful macro wins there.
And on the expense side,
yeah,
SG&A selling, general admin costs.
Big improvement in leverage there. Adjusted SG&A was 52% of sales in Q4. That's way down from 61% last year.
9 points lower. What drove that mainly?
Mostly the marketing spend level. It was 23% of sales this Q4 versus 34% last year.
So they pulled back on marketing dollars.
Not necessarily dollars, but as a percentage of the higher sales base. It could also be timing of campaigns, But the result was that improved profitability. We saw the EBITDA, the EPS that came from that sales growth, the solid gross margin, and getting really good leverage on those SG&A costs.
Okay, circling back quickly to the full fiscal year 2025, just to recap the headlines. 28% net sales growth.
26% adjusted EBITDA growth.
And that huge 190 basis point market share gain in the U.S.
Plus, they hit new record market share levels in both U.S. mass cosmetics and mass skincare during the year, so broad-based strength.
And the balance sheet, can it handle all this growth and investment?
Looks really solid. They finished the year with $149 million in cash, up quite a bit from $108 million.
And cash flow?
Very strong. $115 million in free cash flow generated. That's way up from $62 million the year before. They also tidied up their debt, refinanced into a new $500 million revolving credit facility back in March, give them more flexibility.
What about debt levels?
Super healthy. They ended the year with leverage under 1x. So net debt was less than their annual adjusted EBITDA. And they had almost $250 million available to draw on that revolver if needed. Plenty of cushion.
So strong performance, strong balance sheet. Which leads us to the outlook for this year, fiscal 26. What are they saying?
Well, this is where it gets interesting, and it connects directly to those tariffs we mentioned. Because of all the uncertainty around potential tariff outcomes,
Right.
they are not giving a full year financial outlook for fiscal 26 right now.
Okay, no formal guidance, but what's the plan? What are they focusing on?
The core strategy hasn't changed. Keep gaining share in the U.S., push harder on international expansion. They did give a little color on Q1, the current quarter.
Oh, yeah? What do they say?
Said that consumer buying trends, actual consumption, look better now than they did back in Q4, and they're running well ahead of the overall beauty category's growth rate. They even pointed to April data.
What about April?
Said e.l.f. was the only top 5 U.S. cosmetics brand that actually grew sales in April, and they gained another 130 basis points of U.S. market share just in that 1 month.
Okay, so momentum seems to be continuing into Q1. What about margins for the full year, fiscal 26, especially with these tariff clouds?
They expect gross margin to get some help from price increases. We'll get to those, plus cost savings and getting better deals from suppliers.
Yeah.
But those benefits are likely going to be offset by the higher costs from these new tariffs. And because of how inventory works, some of that tariff cost impact will likely start showing up in the gross margin numbers as early as Q1.
And spending, marketing, other costs.
Marketing and digital spend, they plan to keep that right around 26% of sales for the year. That's pretty much in line with last year and their target range, so continued heavy investment there.
Makes sense.
They do expect the dollar amount of other SG&A, think corporate costs, infrastructure, to go up. That's mainly from annualizing investments they've already made in people and systems, the ongoing SAP rollout, and just the costs of running a bigger international business.
Okay, let's really dive into these tariffs. This seems like the biggest immediate challenge. Where does their production come from now?
Right now, about 75% of their global production is sourced from China.
75%. And those products coming into the U.S. are facing.
As of mid-May, a 55% tariff. That's the old 25% from 2019, plus this new extra 30% that's currently set to run through mid-August.
55%. Wow. What kind of dollar impact are we talking if that stays?
If that extra 30% sticks around for the full year, they estimate the gross hit to their cost of goods sold would be around $50 million annually.
$50 million. That's significant.
It is, and that's before they do anything to try and offset it.
Right.
And obviously, if tariffs went back up to that crazy 145% level that was floated earlier, well, the impact would be much, much bigger.
Okay, so $50 million is the number to keep in mind for now. How are they planning to fight back? What's the mitigation plan?
They laid out a pretty clear three-pronged approach. Think pricing, supply chain, and business mix. They seem quite prepared.
All right, pricing first. That feels tricky for a brand built on value like e.l.f.
It definitely is. They're planning a $1 increase across their entire product line globally, effective August 1st.
A flat dollar, not a percentage.
A $1 increase, yeah. And they made a point of saying this is only the third time they've done a broad price increase in their entire 21-year history.
Wow, only the third time. Why August 1st?
Retailer lead times, mostly. They said retailers typically need about 90 days notice for price changes. And this applies across all their brands, e.l.f., well, People, Naturium, Keys, Soul Care.
How do they think customers will react, especially e.l.f. customers?
Interestingly, they cited some early reads on community sentiment, probably social media buzz, as being like 99% positive or neutral, which is surprising for a price hike.
Very surprising.
They also think that since lots of other beauty brands are expected to raise prices too, e.l.f.'s value proposition, even after adding $1, will still look really strong compared to competitors. So they hope it might even help them gain share.
Okay, interesting take. So pricing is lever one. What about the supply chain? Moving out of China.
They're already doing it and have been since 2019, actually. Long before this latest tariff news, they went from nearly 100% China sourced back then down to about 75% now.
And they plan to keep going.
Definitely. They explicitly said they expect to reduce that 75% figure further by the end of this fiscal year, fiscal 26. They're actively working with suppliers to help them set up shop outside China.
That takes time, though.
It does. It's not an overnight fix, but it's a clear strategic direction. And alongside that, they're also pushing for just general cost savings and better terms from all their suppliers.
Okay. Pricing, supply chain.
Yeah.
What's the third part? Business diversification.
Yeah, and this basically means leaning into their international growth because international sales aren't hit by these U.S. tariffs.
And international is growing fast, right?
Incredibly fast. International sales grew 60% last year. Fiscal 25. Think about this. 6 years ago, international was tiny, like $28 million, 10% of sales.
Right.
Today, it's $250 million, almost 20% of total sales. And they expect that percentage to keep climbing as they gain share overseas and enter new countries.
Any examples?
Yeah, they mentioned launching in over 1,200 Kruidvat stores in the Netherlands and Belgium just this month, and they're rolling out to about 1,000 Rossmann stores in Poland soon. So pushing hard on that expansion. The more they grow internationally, the less impact U.S.-China tariffs have on the overall company results.
That international piece is a really compelling growth story on its own. Okay, let's shift gears now to the other massive news, the acquisition of Rhode.
Yeah, that was definitely the big headline grabber, buying Hailey Bieber's brand.
It feels like a major strategic pivot, almost. e.l.f. is all about accessible price points. Rhode feels, well, different, premium.
It absolutely is positioned differently, but the rationale they gave was about bringing together two like-minded disruptors.
Disruptors, how so?
They see Rhode, despite the different price point, as sharing e.l.f.'s kind of DNA and shaking things up, building a really strong community, shaping culture. They talked about Rhode's unique aesthetic, the lifestyle angle, how incredibly engaged their fans are, people literally camping out for pop-ups. That's serious buzz. And Rhode apparently ranks #1 in earned media value, basically free press among its skincare peers. Less than 1% of its content is sponsored, they said. It's organic hype.
And the performance for Rhode itself sounds kind of insane for a brand that's, what, less than 3 years old?
Completely insane. $212 million in net sales over the last 12 months.
Right.
And get this, that $212 million, it came entirely from direct-to-consumer sales, DTC only, with just 10 products.
Wait. $212 million from 10 products sold only on their website.
Exactly. That points to incredible product loyalty, a super dedicated customer base, and because it's DTC, likely very, very strong profit margins for Rhode already.
Okay, that DTC number is wild. But the big change is the Sephora launch, right? That takes it mainstream.
Huge change. That's the core of the immediate growth plan. They're launching Rhode in all Sephora stores across the U.S. and Canada this fall.
All of them?
All of them. And then into Sephora UK by the end of the year. They mentioned Sephora sees Hailey Bieber as a really thoughtful founder with a unique vision, not just a celebrity face. This retail rollout is going to be massive exposure.
Beyond Sephora, where else can Rhode grow?
Globally, there seems to be huge pent-up demand. Even with only DTC, nearly 20% of Rhode's sales were already international. But get this, 74% of Rhode's social media followers are international.
74%.
Yeah. So massive, untapped global audience waiting for them to expand distribution internationally.
How does e.l.f. plan to help Rhode scale up, given Rhode was mostly DTC? What synergies are there?
Well, first, e.l.f. plans to put significant marketing dollars behind Rhode to build awareness even further. Rhode's aided awareness is only around 20% in the U.S., they said, compared to like 40% plus for similar premium brands. So lots of room to grow visibility.
Makes sense.
Second, leverage e.l.f.'s retail muscle. Those deep relationships they have with Sephora management, that's clearly key to getting this massive all-door launch done so quickly.
Right.
And third, use e.l.f.'s R&D and supply chain capabilities to help Rhode broaden its product line over time, maybe more skincare innovation, maybe moving into hybrid makeup, maybe other categories entirely.
And what about the people? Is the Rhode team staying?
Yes, that's the plan. Retain Hailey Bieber, the co-founders Michael and Lauren Ratner, the CEO Nick Vlahos, and their core team. Rhode will keep operating out of LA.
Okay.
e.l.f. will basically add resources and people specifically to help Rhode with the global expansion piece. The idea is to let the Rhode team keep doing what they do best for the brand, while the main e.l.f. team stay focused on e.l.f., Naturium, etc.
Let's talk money. What's the price tag for Rhode?
Up to $1 billion, potentially. The upfront payment at closing is $800 million.
$800 million. How does that compare to Rhode sales?
It's about 3.8 times those last 12 months net sales of $212 million.
Okay. And the other $200 million?
That's a potential earnout paid over the next 3 years, but only if Rhode had certain growth targets, so performance-based.
How are they paying for the $800 million up front? Cash? Debt?
Mostly debt, plus some stock. About $600 million in committed debt financing and $200 million worth of new e.l.f. Beauty shares issued directly to Rhode's owners. That's about 2.6 million shares of e.l.f. stock.
And how does that impact e.l.f.'s debt levels?
They expect to remain at a low leverage level, similar to where they are now, even after taking on that debt. Their balance sheet and cash flow are strong enough to support it.
And the bottom line impact for e.l.f. Beauty, is Rhode expected to add to profits right away?
Yes, they expect Rhode to be accretive, meaning it will boost e.l.f.'s overall top-line growth rate, their adjusted EBITDA margins, and their earnings per share.
When does this deal actually close?
Expected sometime in their second fiscal quarter of 2026. So probably later this calendar year. And they reiterated, guidance that includes Rhode's numbers won't come until they have more clarity on the tariff situation.
It definitely sounds like this fits their M&A strategy, similar to how they described the Naturium deal.
They really emphasize that. Disciplined approach, looking for brands that are distinct but complementary, force multipliers. They called the Naturium acquisition from 2023 a home run.
How so?
Said it brought great skincare know-how into e.l.f., and in return, Naturium got access to e.l.f.'s huge retail distribution network Ulta, Shoppers in Canada, Boots UK. It helped both Naturium and e.l.f. Skin have banner growth years in fiscal 25.
Okay, great overview. Let's quickly touch on a few other things from the Q&A. Any updates on getting more shelf space here in the U.S.?
Yeah, they mentioned being happy with recent gains, called out Target specifically, but they also said there's still significant runway left, especially at places like Walmart and other big retailers. Still more space to grab.
Was there any worry about e.l.f.'s value customers versus Rhode's premium customers? Like, will they steal from each other?
They addressed that. They think both brands, while skewing young Gen Z, actually appeal across generations. Their view is that e.l.f. and Rhode have distinct enough vibes and communities that they'll mostly build their own customer bases, not steal significantly from each other.
And how's Naturium doing on its own?
Really well, apparently, especially strong in Ulta Beauty. Their body wash is actually the #1 selling body wash line at Ulta now. And they're also massively expanding Naturium's presence in Boots stores over in the UK.
There was a question about Q1 trends versus what the public sales data might show. Sometimes those differ.
Yeah, management sounded pretty confident, said their internal view of consumption is strong, better than Q4, and running ahead of the category. They acknowledge that the comparisons to last year's Q1 are really tough in the tracked data. Because last Q1, they had that huge Walmart space expansion, the initial Naturium launch in Ulta, plus really strong international growth. So the percentage growth this Q1 might look slower against that high bar, even if the underlying business is healthy.
Got it. And that relative slowdown people saw in the January-March quarter, their Q4, what was the reason given for that?
They put it down mainly to lapping a massive innovation cycle from the year before, specifically mentioned those viral lip oils that were huge. They feel the current innovation pace is good, though pointed to things like melting lip balms, the sheer scent blush, selling out fast. So they feel good about the fall pipeline.
Is e.l.f.'s growth just people trading down from pricier brands because money's tight?
They pushed back on that a bit, said it's hard to track trade down directly. Their perspective is it's less about people leaving expensive brands and more about e.l.f. providing access for people who couldn't afford certain things before, bringing new people into beauty categories or franchises at a price they can manage.
How did retailers react to the news of the $1 price increase? Any pushback?
Sounds like it went smoothly. They said retailers told them they expect lots of brands to take price increases. Apparently, there was no pushback on e.l.f.'s plan and maybe even some relief that it was only $1, not a bigger percentage jump. Said the conversations went well.
That huge international growth last year, how does that affect the comparisons for this year?
They were upfront about that. Said the really big growth rates they saw internationally in the first half of last year will make the year-over-year percentage growth look lower in the first half of this year, fiscal 26, just harder comps. But they still expect strong dollar growth internationally through new markets and share gains.
Last one. What if the tariff situation gets really bad? Like worst case scenario, way higher than 55%.
They didn't give specifics, again, citing the uncertainty, but they did say they have a deeper mitigation playbook ready if things escalate severely back towards that 145% idea, for instance.
What might that involve?
Implied it could mean further, maybe more significant, price increases and needing to speed up the shift of production out of China even faster. They stress the balancing act, trying to protect margins and profits while also defending those hard-won market share gains.
So putting this all together for you, the listener, what's the takeaway here? Whether you follow beauty, consumer stocks, or just company strategy?
I mean, you're looking at a company, e.l.f. Beauty, that's shown this amazing consistency in organic growth. But now they're juggling these big external factors like tariffs, while also making a huge strategic bet with the Rhode acquisition.
Yeah, it's a real case study in managing different pressures. How does a value brand evolve? How do you manage a global supply chain mess? How do you integrate a totally different kind of brand?
Exactly. It shows all the levers they're trying to pull. Pricing, shifting production, doubling down on international where tariffs aren't an issue, all while trying to keep that growth engine running.
Okay, time for our segment. This is not financial advice.
Definitely not financial advice. But, okay, think about this. Rode did $212 million in sales last year, right? Only DTC. Just 10 products.
Yeah, crazy numbers.
Now they're launching into every single Sephora in the US, Canada, and the UK this fall. So here's the outrageous but plausible idea. What if Rode just blows the doors off Sephora's expectations? Like, what if sales velocity in those first few months in retail is 50%, maybe even 100% higher than Sephora modeled? If that happens, the retail sales could absolutely swamp the old DTC numbers. It could force a massive, rapid reevaluation of e.l.f.'s total earnings power, making the Rode deal look like an even bigger coup, much faster than expected.
So the trade idea is?
An aggressive long bet on e.l.f., essentially ignoring the tariff noise completely for now, betting that the sheer scale and speed of the Rode retail rollout and its high margins just overwhelm everything else in the near term, assuming they manage the tariff hit through their other plans.
A bold bet, banking entirely on Rode hitting it out of the park immediately in retail.
Outrageous, but plausible given those DTC numbers and the full Sephora rollout.
All right, and a final thought for you to chew on. e.l.f. built its empire on being super accessible, average price around $6.50. Now they own Rode, a brand born from luxury, selling $200 million plus of just a few products at much higher prices.
What does putting those two things under one roof tell you about where e.l.f. Beauty sees itself going? And maybe, what does it say about the future of the beauty industry itself, this mix of extreme value and high-end aspiration within the same company portfolio? Something to think about.